Move on to our questions. This one comes in from JD. JD sent an email earlier this afternoon, and he says, I get confused whether to do credit spreads, bull put or bear call credit spread, or debit spreads, bull call debit, bear put debit, assuming I do either. And he says, it seems the biggest factor would be the market sentiment, moving or not because the percent gains seem better with debit spreads and less risk. Your thoughts? Okay, well, my thoughts on it are this. It depends on the structure you're referring to. A parity trade. A credit to debit parity trade will have the same risk-reward profile, potential return, potential risk. They're not different. What do I mean? We take a look at a stock trading at, say, $65 per share. I want to do a bull put, so let's say I sell a 60 put and buy 57.50. Okay? Now, that probably has a high probability of expiring worthless. It's out of the money. I might be making 20 or 30 cents on a risk of 250 between the strike prices. We're going to go all this visually. I'm just saying it. If I did a parity trade as a debit spread, I'd be selling the in-the-money 60 call and buying a deeper in-the-money 57.50 for a debit of maybe 220 or 230. As long as the stock stays above 60, both spreads make the maximum profit. But they're essentially the same risk-reward tolerance. Now, why would we say a debit is less risk? There are things I may do differently with a debit spread that I would not do with a credit spread. Same stock at 65. I would never do a bull put credit spread, selling an in-the-money put at 67.5 and buying, say, the 62.5 put for a 5-point spread around the stock price. I don't want to sell an in-the-money put because it has a higher risk, or it has the potential risk of being assigned early. But as a parity, a bull call debit that I'm more speculative on, thinking the stock is going to grow, I may sell the out-of-the-money 67.5 call because it doesn't have any risk of being assigned early yet, unless the stock moves above it, and buying a cheap 62.5 call that's just slightly in the money. I would do that with a debit spread. It would have a lower risk and a higher potential return, just lower probability of success. I would not do that with a credit spread. Always remember that debit spreads require an extra commission to close to realize a profit. If I do a bull put spread, my 60, 57.5, the stock stays above 60 at expiration, both puts expire, I pay no more money. In the bull call debit spread, I'd have to either buy to close the short call and sell to close the long at or just before expiration, or allow my broker to exercise the in-the-money 57.5 call to deliver at 60 to get the full profit, which would cost me 2 potential commissions depending on how your broker handles it. On a side note, credit spreads offer one more trick for management if it moves against you that debit spreads do not. Doesn't always work out, but it is one more management technique that you don't get with the debit spreads. Now, spent 5 minutes talking about what those differences are off the top of my head. Let's illustrate those now by going to Power Options. So I'm going to navigate over to the suite of tools here. Okay, all right. And to start, here we go. This is just looking at Power Options here. For those of you who are just getting started, you'll see the 4 steps here on your 14-day free trial. I encourage you to take advantage of those to get more familiar with the tools on the site as well. Start guide, flash tutorials, free webinars, and the coaching sessions you can schedule at any time. There's multiple sessions as well. It's not just one and done. If you're on a trial or if you're a subscriber, you can have as many sessions as you want. Okay. What I'm going to do is go to Bull Put Credit, and I'm going to go to the spread chain. I can access this under any vertical spread, or I can access this little spread chain here under the Signature Tools tab as well in Power Options. I'm going to take a stock. I'm going to take GOOS or Starbucks. Do I want Starbucks? No, I'll use GOS for the time being. And I'm going to say I want a 2-point spread width I'm going to go to December 7th, 7 days away, maybe the 14th. We'll go to December 7th. I want a 2-point spread width. I want a minimum net credit for my bull put credit spreads of about, it's got to be at least 15 cents for me. I want a good probability. Let's just go like 72, even though that's pretty low for me. 72 to about 90. Oh, it was already there. I'm sorry. Minimum returns 2. Now, when I'm on the spread chain, oh, I'm sorry. I want to go to December 7th here, not the 21st. There we go. Now, what I'm looking at initially here, on my right are my bull put credit spreads. On my left are the bear calls. This is a decent tool to use to sort of look at iron condor combinations, but we do, of course, have an iron condor screen as well. Okay? All right, so I don't want this. I want to compare what's better with my probabilities, 73 to 90, 72 to 90 for a bull put credit spread. I want to see what the put credit and call debit parity is. So right up here on the top, I'm clicking on put credit and call debit parity. And now side by side we see the bull put credits on the right as we saw before, excuse me. Bull call debits on the left. Okay. Okay, so now here's a 61, 63.50. That's not what I want. I want to see a, oh, it changed on me. I'm sorry. I want a 2-point spread. My apologies. Okay. All right, so here's a 61, 63. Either spread, bull put or bull call, has an 82.9% theoretical probability. Here I'd be selling the 63 out of the money put or in the money call and buying a deeper in the money 61. The stock you see is at 67.37. So there's an 82.9% probability that in 7 days the stock will be trading above 63, our upper strike. Now naturally I'm going to have to pay a debit to get in the call spread. It's a debit of $1.50. Let's clear that up a little bit. There we go. I have a debit of roughly $1.50 to enter this spread. If the stock stays above 63, I essentially buy shares of stock at 61, sell them at 63. We get $2 back for a 50-cent return on the $1.50 cost, or 33%. At midpoint. This is another tough thing that we'll get to in a moment. Here, I only get a 33-cent net credit for the bull puts. At midpoint, out of the money puts probably have a smaller bid-ask spread, but we only get 33 cents for a 19% return. So in this case, if I was confident that I would get the midpoint pricing, I would absolutely go with the bull call debit. Just makes more sense. And this tool allows me to see that. It's not always the case, though. We go down one more. Wide bid-ask spread on the deep in the money calls, which is something you have to fight. When you're going deeper in the money on a debit spread, you have to fight usually a wider bid-ask spread, and there's no guarantee you're going to get the midpoint. But see here, it's only at 11% return, $1.80 for a 2-point spread. I can get more than double that doing the 63.5, 61.5 bull put, which is probably more likely to get midpoint. This is an out-of-the-money bull put with still about an 80% probability and an in-the-money bull call. So they vary. In most cases, other than two, other than the first and the third in this series, I'm sorry, other than the first spread and the third spread, all the other bull puts have a better return and lower risk than the bull call. How do I know that? Well, the higher return implies a higher net credit, which by definition at the same strikes means a lower risk. I get 52 cents on the same 2-point spread. It's $1.48 risk for a 52-cent profit. Here, it's $1.52, so we have 48 cents of max profit versus $1.52 risk. The bull put credit has the better risk reward for most times. Now, that's why I said the parity trade will have similar risk reward. but there are problems with going with a deeper in the money bull call because of the midpoints. Let's go to the option chain for Goose right now and just take a look real quick. All right, so I'm going to go back to the main page. I'm going to type in GOOS here at the top. We're going to click on chain. It's going to take me right to the 5-strike call and put chain. I just want to see December 7th. And here, there's that 61.63. So if I did the bull call, I'd be buying the 61 and selling the 63. This is a 90-cent bid-ask spread, and selling the 63 is also a 90-cent bid-ask spread. No current volume, small open interest. That's okay. No, let's not worry about that. So it's a 90-cent bid-ask spread. It's much wider. On the bull put side, we have a 30-cent bid-ask spread instead of a 90 for the out-of-the-money put versus the in-the-money call. I'm sorry, this is 30. And here, it's about 35 cents. So am I saying that I'm probably going to get 55 cents on this bull put? Well, it's likely. But even if I only get 50 cents, I think I have a better probability of getting a better bid closer to the ask. I don't know what to expect here. I should be able to only pay 505, the midpoint, 45 cents for the 63 call. I should be able to get that at the bid, at the midpoint, hopefully. But it's a wider bid-ask spread. There's no guarantee you're going to get that. Okay, now, I had mentioned, the second part is I'd mentioned there's things I would do in a bull call debit that I would never do in a bull put credit. And this might be where that second part of the question came from JD. So let's just go to the custom spread tool. And let's look at GOOS. And we already saw for December 7th, the bid-ask spreads, what we would consider the differences between them. What if I went out a little bit further? Let's go out 21 days to standard December expiration. And this stock moved up. Sam mentioned earlier, it looked like a bullish run the past 10 days or so after that little dip in 8 days, 9 days or so. And it was a really good time for some bullish positions. Maybe we feel the same way going forward. So the stock hovering here at around 67, maybe I buy a 66 call. Bid of 380, ask of 420, only 40 cents. Not too bad. I should be able to get about $4 midpoint. And I'm going to keep with, oh, now that's absolutely ridiculous. All right. I'm going to use this 69. I want the 68. For some reason, it's not showing up. I don't see a 68 call here. It should be 67.50, 68, 68.50, 69. Oh, well. Let's use a 69. 3-point difference. What am I doing? I'm selling an out-of-the-money call, which still is an enriched premium here, 235 to 270. I'm going to pay about $4 for this call, and this is ITM. Now, this is only going to have a 40, maybe a 45% probability that the stock will be trading above 69 in the next 21 days. But it's a 3-point spread. I'm paying $4 and getting close to $2.50 back. So I have $1.50 for the potential to make $1.50, which is a 100% return and a 45% probability of getting it. Remember when we looked at those other 2 or 3-point spreads, on the credit spread side or not, we were looking at returns of 10, 15, or 20%. That's not bad. But going slightly out of the money with the bull call debit spread, speculating the stock will be trading up here, my risk is only 147. And I can make over 100% return if it works out and I get the maximum profit of $3 back at expiration. But what happens at expiration? If the stock does move up as I expect, even if it's trading right here at say $68.50, $68 or so, this long call is still going to have some profit. But to get that profit, I either have to sell to close the position Or if the stock's above 69, I leave both open through expiration, and essentially my broker will buy shares of stock at 66 to immediately deliver the obligation I have of the sold call at 69, just as you would with a covered call. So I get 3 points back. What does my broker have to do? They have to buy shares of stock at 66 to cover my obligation at 69. They might count that as 2 stock commissions. They might count that as 2 stock commissions plus 1 options clearing. Everyone's a little bit different, so you've got to be careful of that, because if I just had a bull put and the stock went above 69, both puts just expire worthless. I don't have to pay any extra fees. Or your broker may have some small fees for expiring worthless. Like I said, everyone is a little bit different in that case. Okay? So that's the other difference that we want to pay attention to. That I would do this with a debit spread, which would give me a lower risk as opposed to doing an in-the-money debit spread or an out-of-the-money bull put where I'm only getting 20 cents for a 2-point spread, 50 cents for a 5-point spread, and still risking $4.50 on the margin requirement. And I can have a high potential return. But we might only have a 40% probability of this position reaching full profit above 69, whereas before we were looking at, say, the 63-61 bull put credit spread or bull call debit, which had an 84-83% probability of success. That's the trade-off. The higher the probability, the lower the potential profit. The smaller the probability of making the max return, the higher the potential profit. But this structure, lack of a better term, I'm not going to use the term. I was just going to use the term, but I'm not going to use the term. But going in between, bracketing the stock price with the out-of-the-money call, selling the out-of-the-money call, buying in the money call, I would not do in a bull put. Why? Because if I sold the 69 put, which is in the money, and bought the 66, I'd have a similar risk-reward profile. I'd have only a risk of 145, 150 with a potential to make 155, 150. It'd look the same. But this is an in-the-money short put. It is covered by a long, but anyone who bought this put on the other side could choose to exercise at any time, which means now I'd buy shares of stock at 69, trading at 67.50. Yes, I still have a 66 put, but now I've got to own the stock. This isn't exercised right away because it's out of the money on the bull put side, right? They're not swapping that out. I'm just long shares of stock at $69 that are trading at 67.50. Now I'd have to go into the market and sell to close those shares of stock. I would not do this structure, bracketing around the stock price with selling an in-the-money put and buying an out-of-the-money. I would do this with a debit spread, however, because this is an out-of-the-money call. Yes, I want it to be assigned. Yes, I want the stock to move up, but it's an out-of-the-money call, and I paid less for sort of an slightly in-the-money call instead of buying a deep in-the-money call at 61 and selling a deeper in-the-money 63 for a 15 to 20% return as opposed to a 100% return with this structure. Okay, and then we talked about, yes, the extra commissions. I mentioned something else a moment ago, and that is that a bull put credit spread has one more management technique in my mind than a bull call debit. Okay, let me go back to this real quick. I'm going to go to the midpoint spread chain. Not going to go here, I'm sorry. I'm going to go to the webinars page. I'm going to go to option strategies. There's a webinar here on the 8 ways to manage your bull put credit spread. Further down here we have the debit spreads versus credit spreads, how to be successful, and managing your spread positions with our preferred 7 ways to manage credit or debit spreads. There's 8 for a credit spread, in my opinion, that I use, 7 for a debit. Why is there one missing? Remember, this is our bull call debit spread. We sold 69, we bought the 66. This is a call now. Okay, this is our call spread. If I'm wrong and the stock starts to fall, both options decline in price and are going to zero. I've got to sell to close this long at some point, so I don't get too close to this full realization of the max loss of 147 or 147.50, right? So as this is dropping, I don't want this long call to go to zero. I've got to sell to close it. But if I sell to close it to manage, what's up here? A short call. If I sell to close the long call in the debit spread early, I'm left with a naked call, which is going to skew my margin requirement, and you might not even be allowed to do naked calls in your portfolio. So you can't do that. You'd have to liquidate the whole thing. Let's say I did take a shot in this case, and I sold the 69 put, and I bought the 66. But I did this when the stock was up at 70 or 72. As the stock started to fall to 69, what's happening? Both puts are gaining, the one that I sold and the one that I bought. If I fear it's going to keep declining, I can buy to close my short at a small loss or at a loss. But if I think it's going to continue down, I can now just leave the long put open, and now I just have a long put position. So if the spread starts to move against me in a credit spread, one of the managements is to close the short and leave the long open, and if it continues down drastically more than your expectation, you can actually be at a profit, and maybe a significant profit, by just having a long option. I can't do that in the debit spread, because if I buy to close the short, sure, it's going to be cheap, and I'm going to keep a lot of the premium I originally sold, but this is going to zero. It's not gaining value. I don't want to buy to close the short. I don't want to sell to close the long as it's falling and leave the short open, because then I'm in a naked call. Doesn't work. I don't want to have that in my portfolio. So that's another subtle difference between them, is the debit spreads, the credit spreads offer us one extra management technique. But hopefully you won't get to the management side of it. Hopefully it'll work out for you. But again, this is something I would do in a debit. And the bear put would be reversed, right? I might sell the 66 in the money put and buy the 69. Okay, that would be our bear put debit. What I'd never do in a bear call credit is sell the in the money 66 call and sell the in the money 66 put. No, I was right. Sell the in the money 66 call, buy the out of money 69. I confuse myself when we go this way also. I apologize. Because I don't want to do that. Whenever I'm doing a credit spread, I want the put or the call that I'm selling to be at or just out of the money. I want to look for that 75% probability. And if you're comparing a debit spread to a credit spread and you're talking about parity, you're using the same strikes. Going back to that comment, it doesn't do me a good idea to say, okay, well, I was thinking of a 63, 61 bull put credit spread that carries 3 or 4 point spread. It's called a 4-point, well, it's a 2-point spread, that carries a 20-cent maximum profit on a risk of 180, and say, you know what, this 66, 69 bull call debit is better. Yeah, well, you're not really comparing the same thing, are you, at that point? You're comparing a speculative bull call debit that does have a lower risk, does have a higher return, but only has a 35, 40, 45% probability of reaching max profit, versus a spread that carries a higher risk, lower potential return, but has an 85% theoretical chance of expiring worthless and making the max profit. Although they're both vertical spreads. Although the graph is defined as parity, you can only say you're comparing a parity spread to a bull put credit to a bull call debit if you're using the same strikes and the same expiration. If you're speculative and bullish, and these out of the money bull puts, bull call debits are what you want to trade that matches your convenience and your structure, then you're sticking with bull call debits. Don't do an in the money bull put. Don't be selling an in the money put and buying an out of the money put, bracketing the stock price. You only do this with a debit spread. If you look at the deep in the money bull put, deep out of the money bull put credit spreads with that 80 to 85% probability, where you're looking for a 10 to 15% maximum profit on the position, you compare it to the same strikes and same expiration for the bull call. That's fair game. That's what you do. And in that case, you're selling a deep in the money call and buying a deep in the money call, the bid-ask spreads are going to be wide, and there's no guarantee that you're going to get the midpoint on the bull call debit, in my opinion and experience, as easily as you'll get the midpoint price for doing an out-of-the-money bull put that might only be 15, 20 cents wide, as opposed to 90 cents to $1 to $1.10 on the bull call spreads, in the money bull call spreads. So I went through all of that because I wanted to make sure we were discussing the same thing. Want to make sure that we realize that we're talking about parity. We have to be considering the same strikes and the same expiration in the two vertical spreads. Comparing a deep out of the money bull put spread with an 85% probability to the risk reward of an out of the money bull call debit spread with only a 20% probability is not fair game. Okay, this is not the same comparison. It's not what you want to do. So, review of the differences. Parity trade will have the same or very close similar risk reward if it is a true parity. You can look at that on the spread chain tool and power options, and that put credit and call debit parity, or call credit and put debit parity. You can do different things with the debit spreads that I wouldn't do with the credit spreads. I would sell a 1 month, 2 month, or 3 month out of the money bull call debit spread, speculating on the stock or the market to move in that direction. Same with the bear put same with the bear put debit, speculating the market would fall. I wouldn't compare that to doing an in the money bull put credit spread, where I risk assignment on that short call, short put early, or an in the money bear call spread, credit. Okay. Bracketing the stock price, I would only do with the debit spreads. In this case, the OTM debit spreads would have a lower risk compared to that higher probability out of the money credit spread. Always remember, debit spreads require an extra commission. Why is that really important? Well, look, if you're comparing weekly options, you're looking to sell 5 days out, sell on a Monday for the Friday expiration, you might only be talking about 10, 15, 20 cents of net credit for a high probability spread with 5 days to go. Even if you're out of the money, you might only be talking about 40 or 50 cents on a 1 or 2 point spread. So the extra commission may really come into play even if you're trading 5 or 10 contracts. You got to take into account how much it's going to affect your return in that case, because if you do reach maximum profit on the bull call, that means you held it through expiration, stock was above both strike prices on the bull call debit spread, and you had to close both legs, or your broker did for you. And again, we talked about that one extra management technique I feel is available with credit spreads that's not available with debit spreads. One more quick thought on this. JD's last comment was because the percent gains seem so better with debit spreads and less risk. We talked about how that depends on the structure. I could read this another way. It says because the gain seems better, the percent gain seems better with debit spreads and less risk. That could also mean that he feels that when the stock moves up, you get a better return faster. You see a profit faster on the bull call debit than you do on the bull put credit. Now, I may be reaching here, but I had that question earlier this week as well. So following our discussion we just did, I want to have it to see what that looks like on power options in the portfolio tools. So let's go back one more time. And I use Goose here as an example, but in the portfolio, we're going to take a look at Starbucks. Similar price. It's currently at $66.72. Earlier this week, on November 26, 2018, I could have sold the 2-week out 7th December bull put spread, selling the 62 put at 120, buying the 60 put at 75 for, here we go, total net credit of 45 cents, an expected return of 29%. 45 cents credit on the 2-point spread. Really, 45 versus $1.55, so we're close to that 30% difference, or 30% return. Now, these options dropped drastically in price. The stock moved up a little bit. Starbucks was, I'm sorry, I have my notes here, I apologize. I think it was at 66.20. So it's not really that much, but there was some activity going on between it, some volatility. But these premiums really fell off. And so right now, getting another 5 days closer to expiration, only 7 days away, I could buy at a close, my 62 put for $5 and sell to close the 60 put for 2 cents or $2 per one contract. So it's going to cost me, my liquidation value is $3, which means I keep 42 of the $45 I expected to make on this bull called debit and have potentially a 93% return. Something happened with volatility here. But in this case, it didn't affect the calls too much. At the same time, stock was around 66.28. The 62 call, $4.20 or so in the money, was priced at $5.60. Parity trade. Sell to open the 62. Buy to open the 60 call at $7.10 for a net debit of $1.50. So the maximum expected profit was actually higher here. It was 50 cents for 33.3% return versus 45 cents max profit against a 145 for the bull put, 29 cents. But interestingly enough, the liquidation value here is $48. The gain is $48. It's about the same. I could close this now for $1.98. So it's a 31.7% return. Okay? But it's higher, right? They're about even. I know that's hard to see, but what I'm trying to show you is that they're just about the same. They're not really different. In this case, it's a little bit higher. What it's saying is my total gain is $42 here for the bull put. If I close now, it's $48 for the bull call, which is higher. But remember at the beginning, this bull call had 5 points higher profit to begin with. So this is really just $1 off. Remember, the max expected profit was 50 and 45. I can make 42 now on the bull put and 48 on the bull call. Yes, the bull call is better, but they're about the same. Okay, they're about the same gain or loss in the parity example. Now, if we were comparing it to the out of the money bull call, naturally that would look different. We'd be closer to intrinsic value on the long call we bought. The short call would be getting closer to 0. So we'd probably still be at a similar gain, but we wouldn't be at the max gain just yet, even though we're close to it with both of these particular credit spreads. All right, now, let's see here. Oh, let's go back. Okay, I apologize. There we go. So both of these were entered on the same day. Both of these are near maximum profit because they're parity trades. And we could compare the out-of-the-money ones as well. But I just wanted to illustrate that as the idea is it does one gain faster than the other. No, because you're in a spread essentially on the same stock. Whether you're comparing a bull call debit versus a bull put credit, the bear put debit versus the bear call. If the implied volatility drops drastically or moves drastically on the in-the-money bull call debit spread, the calls, it's going to move on the puts too. Very rarely do you see a spike in the put implied volatility and a decline in the call implied volatility on the same stock for the same expiration cycle. They happen, but it's very rare. It would have to be some really bad news or some really good news for it to be affected that direction. Well, they can go that way. So with the movement of the stock itself, when you're comparing calls or puts at the same expiration cycle and on the same stock, you're not going to see much variance in those positions. So the bull put credit and the bull call debit, if you're looking at a true parity, should have the same types of movement, meaning that you're not going to make money faster on one than you are in the other. At least in my experience. If you have other experiences or other thoughts on that, send it to us. We'll share it as well. Okay, so that's what I wanted to talk about there, the little comparison between bull call debits, bull put credits, credits versus debits, and is the debit truly a lower risk position? I don't see it that way unless you're comparing what I consider two different structures, that out-of-the-money bull call debit versus an in-the-money bull put credit. Now, yes, the out-of-the-money bull call debit, meaning bracketing the stock price with a lower probability, versus the deeper out-of-the-money bull put credit that has a higher probability. They're two different things, even though they have the same risk-reward profile, same kind of hockey stick graph. Parity means same strikes, same expiration when you're referring to vertical spreads. All right. All right, Sam comments in. Earlier he said it was a good bullish week. He says, my SPY straddle at 265 is working well. I'm selling the puts and already made 100% in the trade. And that's great. So we're talking about a call and a put position maybe 2 weeks out or so on SPY as a straddle that he's going to leg in and leg out of over time. There we go. Okay. On a follow-up to that, JD says, thanks, Mike. Thank you for the thoroughness. You're welcome. I'm sorry I got caught up on myself there describing out of the money and in the money when switching between bull puts and bull calls. I might take that whole 25, 30 minutes we just did and clean it up entirely and get all the names right so we have that as a archived webinar by itself with a much clearer view between the different spreads there. Sam asks, is a long straddle better or credit spreads better? That is a really tough question to answer, Sam, because it depends on time frame. It depends on your direction and your timing. I think you're a better timer than I am and a better directional trader than I am as far as that goes. I feel no shame in saying that. You have a 2-month straddle and you're trading SPY. I see no fault in that. If I picked a stock and I think we're in a tumultuous market or a volatile market that's going to have swings one direction or the other, and even though, as you mentioned, Sam, that we may be in a bullish run now, or we have been in a bullish run for the past 8 days or so, going forward, what do I know? Well, there's going to be ups and downs. What does that mean? Okay. Well, just look at SPY over the last 3 months. I'm going to cheat. I'm going to cheat historically. I'm going to look like a genius. Okay, so I can tell you right now, let me get a better view. There we go. That's a little, I want to be right about here. That's a little bit better. I'm going to take RSI off. I'm sorry. I just want to look at a better chart for us all. There we go. That's a little bit better view. Why? Now, with all the differences we can talk about with in the money, out of the money, manipulating bid-ask spreads, manipulating implied volatility, and so forth, from end of August to beginning of October, or somewhere around October 3rd, SPY between 290, 290 and 285, and I think it's even closer than that, isn't it? Oh, I'm sorry, not 290, 295, and 286, 287. Okay, somewhere in that range. All right. So what I'm going to tell you is this: I'm going to look like a genius. I'm just going to say, this looks like a great time to be trading credit spreads, not long straddles or long strangles. This looks like a really great time to be doing out-of-the-money bull puts. Okay, maybe here we get in a little trouble, but then we're good. Maybe here we get in a little bit trouble, but I'd probably be at the 275, 270, maybe the 285, 280, something along those lines if I was doing bull puts. Or if I was doing bear calls, I might be at 295, 300. Spread trade would have been better here than a straddle. All right, I'm not leaving that alone. I just had to change something. Now, this is a beautiful time. Oh, no, to heck with that. This is a beautiful time to have entered any form, middle of October, of 2 or 3 month out long straddle. Of course, if you pick the timing right, October 2nd, October 5th, you pick the timing right, you do a straddle, what do? Profit here on all of the puts. Sell to close your puts. Stock comes back up here. All right, well, at this point, maybe you buy some more puts, and you got profits on the puts again. Maybe you made some profit here on the calls when the volatility increased. You profit on the put here, profit on the put here, profit on the calls, rebracket the straddle, and if it keeps going back up to 290, hey, you've got more profit on the calls. Sell to close and buy more puts, and we fall back down, sell to close the puts. This is what you were doing, Sam, in between here. You were doing straddles and strangles inside of this page somewhere along this line, and these were further out in time, so you're going up and down with the calls and the puts making profits. I do bull put credit spreads here at the beginning of October because September was a nice flat run. What happens here? I'm closing all of my bull put spreads for about a 75–80% loss. I try to get a gauge and I say, oh, it's going down again, so let me do some bear call credit spreads right here. And then here I'm closing those out for 75–80% loss. I say, all right, I need a trend, I need a trend. Oh, look, it looks like it's still going down. It's dropping below the SMA 20. MACD has gone negative again. Let me do some bear call spreads here. And if they expired in 5 days, I was good. If they expired in 14 days, I'm probably losing on these bear calls again, or they're near a threatening point. So which is better? Depends on what you're doing. Now, I do bull put credit spreads that are about 2 weeks out in time following the bull put weekly search default we have on power options. That's part of my portfolio. I had a rough October just like everyone else did. Thankfully, at this point on my married puts, I ended up buying extra puts on my married put position that already existed to create that strangle, so I made profits massively here on those. My earnings straddles worked well. My VIX calls worked well. My bull put credit spreads did not. So I haven't done a new bull put credit spread yet. I should have on Monday. I'm still jittery. My married puts are both looking good. I just opened a new one 4 days ago, and I'm still managing the one that has earnings coming up in a few days. That is bulletproof. My diagonal spreads could look a lot better, but most of my calls for the diagonal spreads I'm using are out 5 to 6 months. So I have time to manage them. They're just not pretty right now, but I did protect some of them with a short-term put. Sam's straddles and strangles he was mentioning are 2 months out. In fact, these ones he says out to February. That's good because he can manipulate them up and down. Would an out-of-the-money debit spread that we talked about that had that higher return, Sam, work better than the straddles? I don't think so, because even if I did an out-of-the-money bear put debit spread at the perfect time, October 5th, what would that mean? Let's say I sold a 290 put. No, I'm sorry. I apologize. I bought a 285 put. No, I was right the first time. I'm sorry. Let's say I sold bought the 285 put, sold the 290 or 295. That would be my bear put debit. Okay? So this is the sell, look like a bear call. In this case, I might be selling the 295 and buying the 290, and then the stock fell. Right? And that's what I'd want. No. Selling the 290, buying the 295. That's it. Selling the 290, buying the 295. Okay, so my bear call would have been selling the 290 there. And as long as the stock's below 290, both calls expire worthless there. Same with the bear put debit. So in that case, even with the out-of-the-money approach, Sam, you would have had a potential 100% return on that out-of-the-money bear put debit, but not continuing profits going down. Okay, and the only way to get that is to close out of the spread. You don't stay in the spread and keep managing it. Well, you can, but you're in a bear put debit that hit the maximum profit. And let's say you did a 5-point spread, but you only paid $250. So there's your 100% return. You're going to get $250 back for $250 at risk. But you don't get more than that unless you continually adjust the position, which you're doing too. And you have this little sell to hedge here, but remember, this is getting deeper in the money as it's going down. The 290, 295 put you sold for the bear put debit. And yeah, you have a 300 up here, right, to do that. But it's still also going deeper in the money with the other put. So you have a capped one, unlike the straddles or strangles where you don't, okay? And you say, yeah, you're selling puts shorter term. That's why I'm trying to compare to you that it's not a fair comparison to say, look, seeing what happened in October, we're doing a straddle this way and maybe selling premium. Let's say this is 2 months out. Your straddle's 2 months out and you're selling premium every 3 to 5 days out when you think you see little trends. Is that better than just doing an out-of-the-money bracketed bear put debit that has a 100% return? I don't think so, because you're still getting more profit on the puts during this than you can, I feel, by potentially rolling the bear put debit further and further, or the bear call further and further to get more profit. Okay? And you've already said you've made all the money. That's great, but now you're continuing the trade. In the bear put debit spread, without management, you would have had your 100% return, still would have had to manage it. Okay, that's the case there. So I don't think it's the same comparison. Okay, hold on. Oh, sorry, something just got maneuvered here. All right, let's go back up. Let me get back to where I was. Okay, so just in regard to that comment there, that's what I was referring to, Sam. Rajiv says, Mike, market driven by news, not on fundamentals. That could be debatable. Individual stocks are still trading strong in the fundamentals, where I had stocks that didn't see as nearly as big of a hit in October as the other stocks did. Of course, the other things are going to be more exposed to the market environment, you know, depending on why the stock's falling. NASDAQ was hit a little bit harder and started to fall first. And then the Dow fell, and then the Dow got hit. But yes, two factors here. If you think that that's the case, that fundamentals aren't driving the market, I still see evidence that it is, because there are stocks that are still safe havens during the decline of October. They lost, but nothing more than you'd normally expect from a normal little hiccup. Not 10, not 15, not 12%. We're talking 3, 4, or 5% of that same 1 month period, because they still have strong fundamentals and strong growth promises. Now, that being said, absolutely. I don't think there's anything wrong with a straddle because you fear market forces being driven by the news. But you were not talking about a 1 week out straddle. We're not talking about a 2-day out straddle. We're talking 1 month to 2 months. Higher cost because you're going to be shifting it as the market shifts up and down as well. Yeah, credit spreads are tough to trade now, Rajiv. He says, you know, credit spreads with the risk being near an 80% loss after October or going into the next cycle, that's what you take on when you take on the credit spreads. You look at a leverage return of maybe 15 to 20%, okay, but you are risking 8 to 1 or 9 to 1, and when it does move against you quick, before you know it, you're at 80% of that maximum loss. Remember, the maximum loss is 100% of what you invested into that position, okay? Yeah. All right. Okay. So oh, sorry, folks. Sorry. Getting over a slight cold. Couldn't find the mute button. I should have warned everyone at the beginning there might be a small concern about a coughing fit. Now, all this discussion on straddles, the discussion I had mentioned earlier about trading straddles for earnings and so forth. Victoria brings in a comment here. She says, hey, whoop. Oh, another comment just came in, so I lost it. Hold on. Yeah, Rajiv, your ATVI question is next after this question from Victoria. I just lost it, though, because 2 other comments came in. There it is. Sorry, Victoria. All right. Earnings straddle strangles. Power Options recommends entering 1 to 2 months ahead of the announcement. Can you please discuss the mechanics of this? Thanks. Actually, we don't. I apologize for that, but we don't. There's a long straddle search. Okay. And it comes up with, well, this was my default for weekly earnings, but there's an initial values here, and it's looking further out in time. It's looking at all expirations 45 to 150 days, 1 to 2 months, as she mentions. Now, what Victoria is also commenting on is on the Long Straddle homepage, there was a help page that should be moved by now that discusses looking at positions 1 or 2 months out. That's not the approach we feel is good anymore. What we're looking at now is you could take this video here, this introduction to straddles, and we're actually looking at shorter term straddles, meaning looking at positions that have earnings coming up within the next 5 to 10 days. I'm only going 2 to 10 days out in time. So my expiration is 7 days away on December 7th, but all of the earnings are coming out on 12/4, 12/5, and 12/6. So I would open these potentially, well, other than these ones here, I might open some of these on Monday, knowing that there's going to be an implied volatility crush and I'm going to lose on those options if I don't get the movement, but there's other factors that are involved with what would be my trading selection. Okay. we're not recommending going 1 to 2 months out anymore ahead of the announcement. In other words, if the announcement's coming out here on Momo on 12/5, for example, I'm not going to be buying a standard December or January expiration series. I'm going to be buying that week's expiration. Okay. Now, it still gives you a wide upper to lower break even because there's implied volatility already factored in. You are going to suffer an implied volatility crush. But if the stock moves, has the movement that you want, you need a much shorter movement to get to break even or beyond. Comparing the different straddles. Okay. This is discussed more, and if you haven't done so yet, just go to that Long Straddle page, Victoria, go to the Long Straddle home, and you'll see this introduction to straddles that Ernie put up, and this is more of what we're recommending now as far as earnings go. I want you to take a look at that this weekend. Okay, that little video there, introduction to straddles, and the discussion of looking at the earnings reports there. What I've been talking about with Sam, and Sam says my earnings straddle is also 2 weeks, meaning that it's coming up soon in that time frame. The earnings are coming up soon, but he's not going more than 2 weeks out. What were we talking about with the 2 months, Victoria? That's a market play. SPY, QQQ, NDX, the Russell 2000, maybe IWM. We're talking about looking at a straddle or a strangle, buying 2 to 3 months out in time, because unless we go through another 2 to 3 months of this from August to early October, where what Sam's doing is, let's say he's got a long straddle on SPY, even if he had a straddle or strangle at this time on SPY, well, he would have been adding maybe a short straddle or a short strangle with a 1 or 2 week or 5-day expiration to keep lowering the cost of his long. This is not something I necessarily advise doing if you're not familiar with it. You don't feel you have good timing because it's more complicated. Not complicated, but it does take good timing. Hence my reference to I feel that Sam's a better market timer than I am based on the discussions he has offered us during these Friday discussions. But that would be okay in this case. But what you're really looking for a market straddle or strangle is I see something change. Even if I missed it and I got it here, if I entered a January straddle, long, buying a straddle, buying a strangle here when implied volatility was increased, I would have had profits here. I would have rolled it and then maybe had more profits here like Sam was talking about. Could have had profits here again on the puts and might be getting back to profits here. And in the meantime, I could be selling some call premium on the high side, some put premium on the really low side, just to continue to lower the cost basis. That is vastly different. Okay. Right, and Sam also adds that every week he has 2 earnings straddles and they're managed after the report. And that's kind of something that Ernie does as well. Also, and looking at the different technicals, the bats, and things of that nature. Okay, so again, for an earnings, check out that video that I pointed you to under the Long Straddle series, Long Straddle tab, in that case. I keep having to change over to the arrow from the pen. There you go. So go to Long Straddle, go to the main view, the Long Straddle home, check out that video on Introduction to Straddles, okay? Get a little bit of insight of it, and then schedule a coaching session or give us a call next week. We'll talk about it more in depth with you, Victoria. We'll go over it a little bit, or you could just send me an email at any time as to what we're looking for with these more weekly straddles around earnings rather than going 1 or 2 months at a time. Okay, now to Rajiv's question. Rajiv brought this up a few weeks ago. He had a bad position. I'm not going to say a bad position. He had a position on ATVI that he accidentally entered in the wrong way. Meaning he was looking to do sort of a put position, a married put position, but I think you ended up you're doing a collar. I'm sorry. So with ATVI, Rajiv was looking to do a collar where you'd buy shares of stock, sell an out-of-the-money call, and buy an out-of-the-money put. And I think what Rajiv did, if I remember correctly, is you more or less did what's called a covered combination, where you bought the stock and sold an out-of-the-money call for premium, but then accidentally you sold the put instead of buying the put. So you had a covered call with a naked put position or something similar to that. And this is what it looks like. It's not something I recommend. There is a company out in Texas that advises their clients to start positions this way. And if you do get assigned, it's okay because they feel they did their fundamentals, and then you just take the extra shares and make it a covered call and get extra profit. What this is that you have to do the covered call, buy the stock, and then sell the call so you have your margin. Then you're selling a put, which is not covered by the stock ownership, is not covered by the short call. So you add the same amount of capital to do a cash secured put. So you've doubled the amount of capital to get a little bit extra premium. Still a 2.63% return, but still has infinite downside. In any case, it doesn't matter how Rajiv did it. The situation that we're in at this time, and we talked about it 2 to 3 weeks ago, the situation he is in at this time is that he's got ATVI. He has not added any legs on this yet. We'd had a discussion of things he could do using the stock repair tool on power options, evaluating buying a put at that time, averaging down, buying another 100 shares of stock, and then doing perhaps the ratio repair. He says he hasn't done anything yet. So we're talking about Activision with a cost basis of around $75 per share, now trading at about 50. Okay, and now Rajiv mentions that now looks like ATV has found the bottom. Should I buy another 100 shares or use the debit spread, then ratio spread? Okay, what he's referring to is since he hasn't done anything yet, now that he feels or he thinks it's at the bottom, and I'm not going to tell you if it is or if it isn't because I can't do that. What I can tell you is that you've had a bounce off the bottom Bollinger Band. You've got a sort of positive MACD going with the rest of the market, though RSI pulled back. Bollinger Band's 20-day moving average actually are still dropping, and it hasn't broken above the 20-day SMA yet. I mean, it's hard to see, but volume has been increasing. RSI has turned again, it's going negative, and although the MACD has had a crossover and is going up, these haven't started really to turn yet, so it's kind of difficult to say, and I wouldn't anyway. But if you think it's at bottom and you think it has the potential to move back up in the next 20 to 30 days, at this point, I might say yes, now might be a good time. So if I bought another 100 shares, let's say 49, what is it, 88? Oh, let's make it simple on ourselves. Let's call it $50 per share, another 100 shares at 50. And the 75, right? So then that would easily put you, your cost basis is what, 62.50, right? Yeah, 62.50 is your new cost basis if you bought another 100 shares. So we look at ATVI, and I'm going to go to stock repair. And if I bought the other 100 shares at 75, buy another 100 shares now around 50, got a cost base about 60, it's all right, 62.50 at 200 shares, mind you. Now, his question is, does he do a debit spread or does he do the repair? Well, there's still no credit repairs that can be built until out to January 2020. It's not there yet. Now, you're not going to get back to break even 10 or 12 points. Could you do another debit spread on the fly to try to figure out if that could get you back to break even faster? Sure. Yeah, and okay, it's just, Sam, that's right. That's what we're talking about here. The repair we're talking about is doing that ratio repair with the stock repair combination there, but it's not here. The computer tells us it tried to build the spreads in February, May. It doesn't look like we have a March series, Sam, or it would have appeared here. The first repair is in January 2020, and you could buy two 47.5 calls for 1020 and sell two 55s for 640. So you get a credit of 520, but it drops your break even to 53.70 with that new cost basis of 62.50. Why? Because the stock's at 53.70, this 47.5 call will have intrinsic value, and the 55 would expire. This is out to January 2020. You're not going to get any time decay until you get closer really to September, or if this option becomes really deep out or really deep in the money because of a large movement. And that's what we're seeing there. Now, why isn't a repair available for the other months? Well, because the credit's not there to repair what you're missing. Okay, you could lower your cost basis down to 62.50. We saw that. If I was trying to build a ratio spread and I had 200 shares at 62.50, you know, if I tried to keep it short term, yeah, so let's try to just go to January, 49 days out, where the stock is. I want to buy 1 and sell 2. Or in this case, since I have 200 shares, buy 2 and sell 4. So I create a bull call debit spread with a covered call. That's the ratio repair. The stock repair tool does all that math for you to help you get back to break even faster. You don't have to do this on the fly. But if this is costing me $4.70, I need a minimum premium of $2.35. So I can't use the 52.5. I can't use the 55. Now if I bought the 50 and sold 2 55s, well, this is at 288. Nope, doesn't work. Got to use the 52.50. I've got to get a credit to do this. It can be done in a debit, but you should really be doing it a credit. So you can only take the next strike up. But then that repair only works if the stock goes above 52.50. Right? So if I bought bought 2 here at about 293, sold 2 here at 1.4 there, excuse me, at 184. And that was the 50, 52.5. It might lower the loss at the maximum point, okay, but you're still at a loss of 1,300 or so with your cost basis of 62.50. Yeah, 62.50 for the stock after buy the next 100 shares. It's only a $1,000 loss compared to the $2,500 loss you're at right now, 1,300 to 2,500, but it didn't get you back to break even. And if it gaps up quickly, you might get assigned and lock in the loss rather than being able to be in a better position to do it at that time. Yeah, I don't know if I'm okay, so that's sort of the ratio repair. So is buying it now and doing the repair a good idea? Well, there's still no repairs available even if you bought more shares at this time. I'm not saying not do anything, okay? I'm saying that I can't really say if this has hit the bottom. I can't really say it's going to move up. Oh, I'm on SPY anyway. That's not what I wanted. I wanted here. Similar chart. It dropped today, you know, and I don't know what to tell you, honestly. Your cost base is at 75. It's at 50. You could average down now and try the ratio repair. We did that. None are available unless you go out to January 2020. It's not a magical fix. You know, it's still confined positions that have a profit. It's just harder when you're down 30, 33%, 35%. In that case, that tool is very powerful to get you to break even faster if something just slipped 10, 15% on you. But when you go to a larger decline, you usually need at least some recovery to find stock repairs in a closer series than, say, a year away. Okay. Do I have any other magic tricks up my sleeve? Well, again, as we discussed a couple weeks ago, that's why that one webinar is there. Back on the webinars page, remember this is a public page. You can access this at any time. You can just go to powerup.com/webinars.asp. I'll send that to everyone there in the chat link. I'm sorry, and you see the tools discussions here, the strategies discussion. Under options concepts, the first one there's manage your broken position, and there's some ideas there that go through, that go through the stock repair, the ratio repair we were talking about, averaging down, then using the ratio repair, looking at other strategies that may help you get back to break even faster or help you hedge some of the loss you're taking, and so forth. So that's just what's discussed in that webinar, and all of the webinars you can access at any time. So other than those ones there, I don't have any hidden trick up my sleeve, Rajiv, unfortunately, to repair the positions. Sam threw out a comment, is that I don't know how I feel about this. Of course, naturally, we'll have to check on Monday. We'll have to check everything on Monday, right? Because we can't do anything over the weekend. But Sam says you could buy calls on a second security, or you maybe look at buying calls on SPY, as that appears to be moving up faster now than ATVI. But I don't know if you want to still keep holding this if it starts to turn again. I'm sorry. Wrong view, folks. I don't know if you want to still be holding this if it starts to go down again. You've got to decide to do something and decide if you feel strongly in this to get out of the position. Has it stabilized? Yes. Is it going to last? I don't know. I don't know. We'll have to see. But I'm not going to make any speculation or projection on that going forward in that regards. Okay? All right. Okay. You can do this as well as I can, Rajiv. I don't know how this would look. I just missed something here. Well, Rajiv threw out another idea. Let's say I averaged down, Rajiv. I had to buy another 100 shares, so now I have a cost basis of roughly 62.50, 62.48, whatever it is. And now we're getting into this rabbit hole. Okay, Rajiv says, what if sell call 45 strike at 6 and buy 52.5 with a ratio 6-5? I don't know. I can't do that. I can't visually see that in my head. If you told me, what if I did a collar at these prices, I'd know exactly where you'd stand. Doing these ratio things, I don't know it off the butts of my head. Let's look. I'm going to sell. Let's talk about this. You own 200 shares. Now, to average down to 62.50, you want to sell a 45 strike deep in the money call, 17.5 points below your new cost basis of $6.50 for about $6. Okay, so we'd be going further out. Let's say we'd be going to January here. Is that $6 at the 45? Did you say? Yeah, okay. 45 and buy a 52.50 at 180. In addition to that, you say the quantity of 5. So you've got 200 shares. You're selling 5 calls, buying 5 52.50s on a stock trading at 49.88. So this is your out-of-the-money bull call debit. This is an out-of-the-money call. Oh, no. You're doing a bear call credit spread, right? From what you said, Rajiv, you're selling the 45s and buying the 52.50s. You're entering a bear call credit spread against a stock that's down 12.5 points from where you bought it, meaning the spread might make the full profit if it goes below 45, but you'll lose money if it goes to 52.50. It leaves the upside open, but your break even isn't up here until 70.57. What did you do? You lowered your cost basis down to 62.50 by buying another 100 shares. Okay? That's your break even. By doing this bear call spread, you collect premium, you leave the upside open, but because of the structure of the trade and the obligation at 45 and the right to buy at 52.5, which is still out of the money, this means your new break even doesn't get hit up here until 70.75. Why complicate it? Why not just leave the long stock with a cost basis at 62.50? This hurts you more than it helps you. It doesn't lower your cost basis too much. It doesn't lower the cost basis by enough there. It does drop it a couple thousand at that $2,100 roughly. But man, it's just by buying another 100 shares, you lowered your break even down to 62.50. Now trying to get a little bit of premium with this spread that does leave the upside open, but your cost basis is too high, you increase your break even to 70.57. I don't think that's a good idea. And then you say selling 2 of the 45s and buying 5. Only if the stock really takes off. If the stock doesn't really take off, you're not giving yourself much benefit at all. Okay, you're getting $1,200, you're getting $300, and you'd be obligated to deliver shares of stock at 45 that you own at 62.50, 200 to 2. They'd probably cover the stock first, and then you have 5 long calls at 52.50. Break even at 58.89. You think the stock's going to go up 9 points in 2 months? I mean, yeah, if you average down, you have a cost base of 62.50, but at that point, does it really help you? And Sam mentions that comment. I think he said this 2 weeks ago too, but it's unfortunate, but sometimes it's better to go forward and look at another stock which dropped like Facebook. He says he bought it at 132, and today it closed at 140, so it had movement. Or buying calls on that. You still got to be right on those. It's a problem there that you could get hurt in that situation, you know. So this is the graph of it. This is what it would look like if you did what you're talking about, Rajiv. I can't comment if it's a good trade or a bad trade until we know the future. I can tell you the pros and cons of it. And that's about it. Okay, and I don't know if this is helping your position greatly or if it's just adding to a complication for a small amount of premium. $300, excuse me, on 200 shares, which works out to be about $150 or $1.50 per share. Okay, I don't know. All right. 547, that's not a problem because we do have other questions that came in. Victoria starts us off again. We go backwards here. When we talked about the straddles, now we're looking at something else. She said, I did a stock repair. Stock is 1 cent below I bought it. How to best unwind the repair or let it go to expiration? And you're talking about CRON, 300 at 913. All right, let me jot this down. We have CRON Victoria at a cost basis of 913. My apologies. The current stock's rate at 912. Now, your repair when you did this, when it was lower, you bought 3 at 850 and you sold 6 at 9. Good, okay. Both now are ITM. The repair expires next week. Oh, okay, and you put it in the portfolio, but you don't have a position analysis, okay? How could I get back to the analysis in the stock repair? Originally showed me when I put this on. Okay, you won't be able to, same way you do before, I'm sorry. So you had mentioned, Victoria, that you can put the stock, you can put your position into the portfolio. I'm going to fake some numbers here. Here's our credit versus debit portfolio we're looking at. I just go to Starbucks. And I'm going to add a custom spread. I can do this in the portfolio, even though I won't be able to track it. So you've got stock, I'm sorry, CRON. And I don't know your original purchase price or your purchase date, but at some point you had a cost basis of 913. I apologize. And it dropped down below 9 into the 8s. And for next week, you bought some 850 calls and you sold some 9-strike calls as well. 2 to 1 would be, that's still pretty decent, but let's knock this down to 65 and let's put, yeah, that looks good. It doesn't matter the date really. Oops, I got to edit that, but that's okay. I need to edit these. Edit position, what did I do wrong? I can't edit it. I'm so sorry. These were sell to open. I apologize. I got to go all the way back. Can I do it here? No. Oh, I can do it this way. I'm going to delete those 6 from the portfolio, from the errant mistake I made on Chrome through the more information buttons. I'm just going to add a new option leg. I'm sorry about that. Let's sell 6, December 7th, 9 calls. It doesn't matter, but I'll still use the same fake date. Okay, Victoria, there we go. Now, I don't have a position analysis for this strategy, but I've got a 3-leg trade where I'm long 300 shares, long 3 long calls, and I sold 6 December 9 calls. So where is your original view? Here it is. This is what the repair originally looked like. 300 shares, 3 contracts at the 850, 6 contracts at 9. This is sort of your repair. The stock's at 915. Here it's going that direction. Then, of course, yeah, it's a little skewed right now because of the strike differences. So what are the management now in this case, Victoria? What are we looking at here? Because you don't see it on power options in the position analysis view. Well, what do we want to have happen in this case heading into expiration? Okay, well, what we want to have in this case heading into expiration is we want the stock to remain above 9. So you get the benefit of that 3x3 bull call debit spread that you bought 3 at 850, sold 3 at 9, expires in the money. You know, deliver your 300 shares at 9 and maybe buy another 300 shares at 850 depending on how your broker handles it, or they just close it. If you get closer, Friday's expiration, the stock's still above 9, these are both going to go to intrinsic value or close to it. Your 850 call is going to be worth about 50 cents. Okay, well, it's at 9.15. So this would be at about 65, 67, 70 cents, and this would be at about 15 or 20 cents. You could sell to close your 6 longs, buy to close these. You're getting essentially intrinsic value back. You've got the benefit of the debit spread plus the income you received on the position. Okay, closer to break even, you've lowered your cost basis a little bit more. If the stock starts to pull back, you're not necessarily worried about these 9 calls right away. What you're worried about is these 850 calls losing value. You want these to have some value. But remember what you can't do, Victoria. You've got 300 shares of stock and 3 long calls and 6 short calls. I can't close these 3. I can't sell to close these 3 because the stock starts to fall and say, you know, I want to get at least 40 or 50 cents for these, because now you have a covered call with 300 shares and 3 shorts and 3 naked call positions, which just lose infinitely to the upside. That's not what you want. You'd have to buy to close 3, sell to close 3, and then you could just leave 3 open. Another way of looking at this, if you go to expiration and CRN keeps moving up, just leave 3 and 3 alone and treat these 3, the remaining 3, the extra 3, as just a covered call. Stock goes to 950. You own stock at 913 minus a little bit of premium and maybe some other things you could price in early, and you sold 3 calls, 3 9-strike calls at 50 cents. You've got a covered call, 3 and 3. What would you normally do to just a covered call where you have 300 shares of stock at $9.13 and you sold 3 9-strike contracts for 50 cents? Would you let it get assigned to take the profit? Are you still bullish long-term on Crone? So maybe you'd buy to close these 9s for December, the 3, just 3, and then roll to January, 950, 10, depending on the premium. You know, would you look to do that? At that point, leave the 3x3 alone as you get closer to expiration, knowing your broker will likely cover this as a bull call debit spread, buying 300 shares at 850, selling them immediately at 9, and then just treat the remaining portion as a covered call trade, 3x3. How you'd roll a normal covered call based on your expectations and your outlook for Crone is how you would manage this ratio call spread. Okay, that's one way to look at it. That's how I usually consider it. All right. Sam follows up on some of my comments. He says, Mike, I don't think it's a good idea to suggest buying more shares of ATVI based on the chart. I don't think Rajiv should be putting more money in. Yeah, I only mentioned that in the case of lowering the cost basis to try to find a stock repair if he chooses to stay in it. If he gets out of the trade as well. And Sam goes on to say, when a stock drops big time after earnings, big money is selling out of the position, and when the stock does not recover in a bullish market, then you should know something is potentially wrong, and that should be a concern. So he's just offering some thoughts there on ATVI. He continues on to say it might need earnings in order to jump back up. That's always a good catalyst if, in fact, it's positive. If it goes negative, well, we're still in the same situation. And he throws out a couple of other names there, Dollar Tree and Burlington Coat Factory with good earnings. I've got Ollie coming up, OLLI, Ollie's Bargain Outlets. I want to see how that one goes. And Goose had some strange earnings. They didn't do as well as I thought from the earnings move. They did well a few days after, and then the little hiccups started to hit. So it didn't do as well as I wanted with GOOS. But I did well, just not as good as I wanted to. All right. Well, I think that covered everything that I saw come in today and everything that I had that came in via email as well. Regarding all of this, and I'm sure this is, Sam would point this out as well, our discussion today, a discussion on stocks, on strategies, options, trades, management techniques, repairs, These are my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions or recommendations. Options do involve risk and may not be suitable for all investors, and you want to make sure that you have the proper education and always practice proper position sizing in any sort of long call, long put, long straddle we're talking about, bull put credit, bear call credit we talked about, and more. Remember, on those strategies you can lose 100% of what you invest. And you can tell me buying a long call is low risk, it's less risk than a stock. Monetarily, you're right. But if I put $50 into ATVI right now as a purchase, which I would not, but just as an example, if I bought 100 shares at 50, the stock fall 10%, I'm out $500. If I did a bull put credit spread by selling the 45 puts and buying the 40s, and I receive 35 cents and the stock drops to 44, but I did 20 contracts, I'm going to be losing close to $2,000, okay? Or, I'm sorry, $1,100. So remember, it's also about position sizing. Options do involve risk, and they are leveraged. If you're not using them for protection as a married put, married call, or as a long collar or a short collar, or hedging a straddle, as Sam had mentioned, having a straddle but then using a put or call to hedge it, then you're using it to speculate. And position sizing is the key, and that's where most people get in trouble. So remember, get the maximum risk of your position, look at the monetary risk of your position, assume the worst case scenario, and then ask yourself, can my portfolio stomach this? Well, I have a lot more information on that going into December, or last month of 2018, on position sizing, risk management, risk control. You'll see a lot of emails coming out about that soon, so look forward to that. Oh, sorry there. If you haven't done so yet, remember you can always go to powerop.com, put in your first name, last name, and email address, and you'll have full access to the tools you saw today. The portfolio tools, the profit and loss, the stock repair tool, other signature tools that are available also. Default searches we have for the strategies we discussed, including the straddle searches, bull put credit spread searches, bull call debit, and more. First name, last name, email address, you have full use of our site for 14 days. After that, our subscriptions start at $14 a month, and they do go up based on further subscription levels for delayed service, access to the historical tools, the backtesting tools, and more. And of course, you can always get other free information. You can go to the blog, blog.powerop.com. As mentioned, you can check out our webinars page, powerop.com/webinars.asp. It is a public page. You don't need to be logged in. You can also find us on YouTube, of course. Just look under Power Options. If you think of any other questions, why is that not doing what I wanted it to do? That's why. Oh, sorry about that. There we go. Let me just rewind it there. So, yeah, you can go to powerop.com, first name, last name, email address, start your trial. Subscriptions start at $40 a month. That's just for the end-of-day data, and we do have other levels of service after that. Other free information, blog.powerop.com, powerop.com/webinars.asp. You can go through our archived webinars as well, or on YouTube. And if you do think of any other questions later on, remember, send me an email at any time, support@powerop.com. You can also email us to support@radioactivetrading.com. And then you can also call us during market hours at 302-992-7971. And trial members and subscribers can schedule a coaching session. Sam points out he's doing something right now. I think Ernie's doing maybe a little bit more. He's 50% trading, 50% cash. Okay. When I tell you that my portfolio consists of 50% of married put positions and collars, with maybe 10 to 15% in bull put credits, 10 to 15% in calendars, and then some in those playing those earning straddles as well. What I'm referring to is the amount I'm actually investing in, and it'll scale back and forth. But essentially, what I mean by that is that whatever I have in the market at the time is usually invested in that breakdown. Okay. I don't have the fear of a market correction, because at any time 50% of what I'm trading is in the radioactive and married put techniques, where I can only lose 4% maximum at any position, and I'm still managing them with spreads and with covered calls and with other strategies inside that nested position. And then managing the other trades we talked about, bull puts and so forth. But I may scale that back in different market conditions, meaning that my whole portfolio, let's say I had 100,000, I might only be allocating 65,000 right now in that makeup. And if the market turns weaker, I might pull it back to just what Sam says, 50% in trading and 50% in cash. But that 50% I'm trading at the time is going to be 50, half of it will be in married puts, and then the other amount of that 50,000 and so forth. And Ernie's pretty close to the same right now. He's sitting on a lot of cash right now, although I saw him pull a few triggers on things a few days ago as well. Wednesday or Thursday. I'm going to throw this back up here because I count this as my disclaimer. I read it to you, but I didn't show it on the screen. So again, my thoughts on your questions, designed for educational purposes, increasing investing performance. Any stock or options discussed today should not be taken as direct trading suggestions or recommendations, just thoughts and ideas on management techniques acting as a second pair of eyes in your positions, or thoughts on the strategies. Options do involve risk. Position sizing is key. Even though you're using leverage to see a high return, don't overtrade, because that's where most new and even old options investors get hurt. When they think they found a sure thing and they overtrade, the sure thing turns out to be the exact opposite of what they thought it was. Or sometimes it turns out to be a sure thing. Ladies and gentlemen, thank you for your time. Thank you for your questions. Have a fantastic weekend. We'll see you soon. Good night.